entrepreneur turned venture capitalist, and I thought I would tell you a little bit about that journey today. And the hope is that I would leave some time for questions and figure out what you guys want to talk more about. So I'm going to get through that story a little earlier and leave some time there. So I was at Ohio State University studying holographics. This was 30 years ago. Most of you probably know what a hologram is today, but back then it was kind of a new thing. I had seen my first one when I was 14 and just became enamored with the whole process of it. There's physics, there's math, there's science. Luckily, those things were comfortable for me when I was in school, but I didn't really know what I was going to do with it. Came up with some ideas about using holographics for computer storage, and found out as a 20-year-old with an idea to start a business that takes tens of millions of dollars, it's very difficult to raise money. So I went out and talked to the people you would think you would want to talk to. I talked to banks. Of course, it was impossible to raise money from banks with that kind of theory. I ended up talking to venture capitalists. They laughed even louder than the banks did at my story. But along the way, I did have a pretty interesting epiphany. I had just gotten an incomplete in my economics class at Ohio State, but I remember this supply and demand curve that they were talking about. And the 3.5-inch diskette, so I'm really dating myself, but it looks like some other people in the room probably remember these too. 3.5-inch diskettes were brand new technology that had just come out, and the Apple computer was using it. And there was an obvious trend that was happening. For those that remember this time, we were moving from text-based to graphics-based computers. And it was really obvious that a lot more storage was going to be necessary in graphics. And I thought holographic storage was going to be the way to get there. But there was a miss in the market. The manufacturers of 3.5-inch diskettes, when we had called around as part of the research for holographic storage, we saw that they weren't making a lot of them. But if you called on the other side, the people that were looking to buy the Macintosh computer, use it in the publishing world, there was going to be a lot of demand. So I remember this incomplete that I just got, but that curve, and I went out and bought every 3.5-inch diskette I could get my hands on. Now, I didn't have the money to buy them, so I had a Honda Prelude. I sold it for $5,000. Back then, banks actually lent money. And how many bankers are in the room, by the way, before I do too many more? You guys are all awesome. We love you today. But back then, I actually got a 7-to-1 ratio against that $5,000. You couldn't do that today. But I put $5,000 in the bank, got $35,000 loan, used that to buy some of the diskettes. But mostly, I got the vendors to give me terms. I'm going to pay you when I sell these. The Chamber of Commerce was very active at the time in international business and really was helpful. This was back before email, back before fax machines. They had a telex machine there. It was helpful for international communications. They made introductions for me. And Digital Storage International was born. Within 3 months, through a couple lucky breaks, one of my college roommates happened to have a father with the Venezuelan government who was one of the early customers of mine. And then another lucky break with the introduction from the Chamber of Commerce, the largest distributor in Europe, ended up being one of my first customers as well for 3.5-inch diskettes. And about 3 months into it, I was the largest distributor for 3.5-inch diskettes in the world. You know, kind of luck, but since I was the only one that had them, because I had called and ordered every one I could get my hands on, we looked smarter than we probably were. And from then on, every trend in computer storage, people said, well, that digital storage company had the last product, why don't we call them? So we had a really intensive sales training process. We just said yes. So when people called, they said, do you have an 8mm tape? Yes, we have 8mm tapes. Get off the phone, we'd say, okay, what's an 8mm tape? We'd go find 8mm tapes, so we'd start to bring them into stock. And so the whole trend, CD-ROMs and CDRs and DVD-Rs and all those tapes and up to thousands of different types of computer storage, we ended up with offices in Europe, Latin America, Pacific Rim, and you know that company was was and still is the largest distributor in the world of computer storage, which is a very different world today, as you might know. But along the way, an interesting thing happened. We realized that being a wholesaler of computer storage was really two facets: marketing and logistics. So on one side, we have Hewlett-Packard. Yeah, there's my logistics experts over here. So on one side, I did get a lot of advice from this young man over here along the way. But, oh, wow, this thing actually, you get it closer to your mouth, it works better. So on one side, I had Hewlett-Packard, IBM, Sony, 3M, really talented companies. On the other side, as a wholesaler, people like Walmart were customers, very sophisticated companies. And so we had to apply marketing and logistics in a way that was more sophisticated than some of the most sophisticated companies in the world. And in the mid-90s, my company morphed, and I started 8 more companies thematically marketing technology. So think databases, data management, the internet was a brand new thing. And all of these companies were trying to get their arms around what that would mean for them. And they were all really good at making lots of products and shipping them out in truckloads. But the idea of taking those truckloads, breaking them down into little boxes, combining it with other people's boxes was still kind of a new thing for all of those people in the supply chain. So on the logistics side, it was figuring out how to do that. How do I apply technology to remove redundancies and reduce cost? By the late 90s, many of my friends in the YPO, very similar group to this, of business leaders, kind of grabbed me and said, "Rich, you can actually sell companies. You don't have to hoard them." And it ended up that the late 90s was a good time to sell companies. I can't tell you I was smart enough to tell you what was going to happen next, but selling tech companies in the late 90s was a good thing. So I think a lot of you have been through this experience. You sell a couple companies, you make a little money in Columbus, everybody's a great friend all of a sudden. So all those boards that Michael mentioned, I was called into duty, and I was happy to serve. What was my contribution to Columbus going to be? Columbus was very good to me. I only knew the one thing, entrepreneurship. So I started and funded the Center for Entrepreneurship at Ohio State, and I was drafted onto the early days of the Columbus Partnership. Who all's aware of the partnership and what they're doing in the city? So you guys are all pretty aware of it. I'm glad to hear that, because I think that, and this is not for me, it was Les and John in the early days, just did so much that we still don't all know in the city how much was done by that group. But they drafted me on what was called the core committee. And what we did is we got together once a week with McKinsey, and the bold vision was, how do we become the greatest city in the world? And how do you measure becoming the greatest city in the world? And I'll paraphrase tremendously the McKinsey research and all that time, is we had to get very good at innovation, we had to get very good at talent, and we had to get very good at capital. Because the cities that had grown anywhere else in the world did those 3 things really well. And so we started to get organized as a city. And Columbus 2020 was born out of that. And we had one of the greatest, it wasn't an accidental happening, but it was a happening that I don't think we could have predicted, in getting Kenny McDonald, who's one of our leaders in Columbus. And he did such an amazing job on the traction front, bringing new people to town. So you see all this Facebook and Google and all these companies moving here. That's really Kenny's leadership there. He's done a tremendous job. But the Columbus Partnership's early role in innovation was kind of leaning in on those things. So innovation was happening. We have Ohio State, we have Battelle, we have Nationwide Children's Hospital. There's a lot of innovation going on in this room, I'm certain. But it wasn't organized. So we started organizing innovation. For instance, I don't know if a lot of you know this, 20 years ago it was actually illegal to commercialize something out of Ohio State, because it's a land-grant institution, so that was considered to be an asset of the people. So, how inspiring is it if you're a brilliant innovator to come to Ohio State and create a technology that could be worth billions of dollars. So we weren't getting those kind of innovators here in Columbus. We had to change the laws. We had to structure what good commercialization looks like. Traveled around the world. We found best-of-breed models. We brought them back here to Columbus. On the talent front, the Center for Entrepreneurship just ended up lining up really well against that goal. We went from having really no program at all in entrepreneurship to 400 students a year now get touched by that program. So that organization really came together well. And then the last piece was capital. And surprisingly enough, there's lots and lots of capital out there. There's always been lots of venture out there. But what we found is people don't get on airplanes and fly to Columbus, Ohio to give $1 or $2 or $3 million to a startup company. They didn't 15 years ago. They still don't today. Venture is a contact sport. It has to be done locally. Now, we had raised hundreds of millions of dollars as entrepreneurs, and I really thought we could talk those people into moving here. And we tried, and we tried, and we tried, and we did not have any success. So our path to venture was kind of reluctant. We threw a shingle up really to say you could do venture capital here in Columbus, Ohio. So we built our first fund, NCT Ventures Fund 1 in 2008. That is now fully invested. We did our second fund in 2013. That's now fully invested, and we're actually raising a meaningful venture fund now in 19? So that'll be Fund 3, and we did a couple other smaller funds along the way. But now, you guys, I think you've had Mark Kwame here to speak to you guys. Mark Kwame, people like that, Sequoia Partners, are coming to Columbus, Ohio, and building a footprint for their funds because we are the kind of place you want to invest. And if you look at Forbes and Fortune magazine, there's story after story about Columbus is the #1 tech city, the #1 growth city. And since Mark's already spoke with you, I decided I wasn't going to spend a lot of time talking about that. But I will say that when you look at all the technologies of today, artificial intelligence, blockchain, AR, the kind of things that will make marketing and logistics innovations, B2B exchanges more efficient, all will be innovating here in the Midwest. Why? Because we have the real companies. Mark says this well, they have the internet on the West Coast, we have the things here. So if you think of the Internet of Things connection, we have the real companies, the farms, the manufacturing companies, the insurance companies, those wonderful bankers that I saw in the room. Those are all here, and that's what connects and binds this. So I'll spend just a few more minutes on venture capital and then leave some time, as I said. So how many people feel like they're really familiar with venture capital? Just start there. It's actually more than a general room. And I think venture capital is still a very little known asset class. If you go back and look over a 5-year history, a 10-year history, a 20-year history, 30-year history, it's actually generally the best performing asset class. Farmland is now giving us a little run for their money lately. But why is that? Because it's a little risky, but the kind of things that happen on the other side have very high reward. The new news in venture capital is it's becoming less and less risky. People have been at it for a while, and they're starting to get pretty good at the formulas of what it means to be a good venture-backed company. So in our world, what we're doing is we're meeting with lots of entrepreneurs, thousands of companies. We're having them submit data to us. We're using our own artificial intelligence technology to review that data so we can look at lots of companies and make rational decisions out of them. And we're looking at the core, just like you do with all of your businesses. What is the cost of acquiring a customer? What is that lifetime value of the customer? What's the retention rate of the customer? And what's the speed of growth? And if that speed of growth and the total addressable market are large and they've got that business model down, they make a good candidate for venture capital. Most of the time, companies don't have that. And so most of the time we're saying, no, you're not a good candidate for venture capital. In fact, when I teach at Ohio State, I usually tell students in kind of day one of any class, never ever take money from a venture capitalist. There's really very few scenarios where venture capital does come in handy. And people do take money from venture capitalists that don't, and that's how, when I was getting introduced, somebody used the word vulture capitalist for a moment, but that's how that kind of association happens, is that venture capitalists, they aren't in the business of giving you money, they're in the business of getting more money than they gave you back. And if that doesn't happen, they end up taking over companies and kicking out management teams, and that stuff isn't fun. We call ourselves kinder, gentler venture capitalists. So myself and my partners, Bill, Lindsay, Michael, have all been on the entrepreneurial side. We know what it feels like to be tight on payroll and to be growing companies, and I think that makes us better venture capitalists. So the asset class is very strong. Basically, it's a little different than most investing. When you give money to your investment manager and you pay an investment management fee, if they do good, you pay an investment management fee. If they do bad, you pay an investment management fee. In the venture world, when you give money to a venture capitalist, there's a management fee, but we have to give it back to you. And we only get paid if we make you money. We make 20% of what we make for you. And I like that personally. It just feels like our interests are 100% aligned. And there's nothing wrong with the normal investment model, but a lot of people don't understand that venture's a little different model there. And they only get paid if they actually make you money. And I guess the last thing I'll mention about venture is kind of the trend forward. Like every industry, there's a lot of money in venture right now. There's a lot of money in the public markets right now. But more than ever before, we have proactive calls coming in trying to get more money into our next venture fund. And so we were trying to listen, why is that? And what we're finding is the smart kind of large-scale investments, the foundations of the world, are looking at the future of the public markets, and for the first time they're saying, I don't think we can depend on that 10, 11, 12% anymore, and they're projecting closer to 7 or 8%, maybe 9% going forward, so they're starting to diversify their asset classes. And so more money is rolling into venture than ever before, which means more stupid people will probably get money than ever before. And it's probably more important than ever to really look at the quality of who you're actually investing through in the venture world. And new asset classes are really becoming intriguing. So I mentioned the farmland investment. It's one of our new investments we're making is in a farmland marketplace because it is such a hot marketplace today. So anyway, trends in venture, entrepreneurship, whatever you're intrigued with, I'm ready, and hopefully we'll get some questions because it's really, really embarrassing when you don't get questions. Thank you, sir.
Last night, 60 Minutes had a story about a California group, and J.D. Vance of Hillbilly Elegy is part of that group, and he's an Ohio State grad. 20 years ago, when I was teaching school at Miami of Ohio in the finance and accounting area, Cincinnati had a lot more venture money than Columbus did. Where do we stand? 3 cities were identified in that story last night: Memphis, Baltimore, and Indianapolis. Where do we stand relative to the number of groups like yourself in Columbus compared to some of our competitive cities, Nashville? Where do we stand?
Great. Well, they said repeat the question. There was a lot there to repeat. But in general, there was a great show on 60 Minutes last night, Steve Case and J.D. Vance. J.D.'s back here in Ohio. He's down in Cincinnati now. He was actually the speaker at our annual meeting last year, and he's a great personal friend. J.D. and Steve are an example of, they proactively did research. And so how many people saw the 60 Minute show last night? It was a pretty solid show. They did research, and what they, are now kind of out touting is that 75% of the venture capital goes into 3 areas, and it's basically 3 zip codes. We know where they are, and the other 25% shared by the rest of America. And the theory is is the rest of America that much less interesting than those 3 zip codes? And when you break it down further, only 2% go to women and less than 1% to minorities. Are women that much less innovative than other people that are getting capital? And so something's broken, and they've really extended the theory. I mean, most of us would say there's something broken in society today. I mean, I'm not going to get into a political thing here, but most of us would say it's pretty polarizing if you look out on social media. What's broken? And the theory that Steve and JD have is that not everybody's been able to benefit from prosperity that's happened. And how do you create that? So they've actually made a large commitment to our new fund. They're putting their money where their mouth is. And they are saying, we believe that the Midwest is the new frontier. And they like that we have a very high level of commitment to diversity and inclusion in our fund. And the second half of your question was about how do we stand as a city, Columbus, against the Memphises and Indianapolises and so forth. I'm surprised they didn't mention Columbus, because they're the ones that put forward that Columbus is the best place overall. I think they're trying to help those other areas rise up, but we're crushing everybody like a grape. Columbus is the fastest growing city. It has the fastest growing amount of venture been added to it. It has the most venture going into the entrepreneurs, which is the number one way I like to rate it. If you just look at local venture going into the companies, it's only part of the story. It's how much venture are the companies in Columbus raising as a percent of the population of Columbus. Best by far in the Midwest, and really kind of getting into the top couple in the nation now. So Columbus is doing great. Did I get to everything in your question? Sorry, I extended your question into my answer, so. Yes, sir.
And then you. How does venture capital get involved with the agricultural or the farm aspect of it?
Yeah, that's very interesting. So how does venture capital get involved with farm? And I think that the question that I'll start with is, how is technology getting involved in the farm? And it's actually, I'll go way back for a minute. I talked about our company making the transition from being a wholesaler of computer storage to a marketing logistics company. I met a gentleman at an event, and we were going around, we were all supposed to be talking about what does our company really do? And he said, I take energy from the sun and I turn it into energy for people. I said, oh, you're in the solar business. He said, no, I'm a farmer. And what he realized is that was the business he was in, and he moved it to a technology company. So what is the technology of farming? How can you do that more efficiently? So now we have inside greenhouses that can produce 7 times the amount of crop in the same amount of space. We're invested in a company called Iunu out of Seattle that has an artificial intelligence combined with a video recognition. So it watches the plants grow, and it says this area needs water and this area needs fertilizer. Statistically, by the way, I'm watching this plant grow versus my database of what a healthy plant set should look like. There's things like Acre Trader, which I mentioned a moment ago, that's in the farmland and timber business and the trading business. And if you really extend that out, the whole logistics supply chain of agriculture is being disrupted in a good way as people want to get more local. Another one of the groups of the Walmart family has been very involved with some of the things that we're doing here. They're actually bringing a trade mission to Columbus on the 8th and 9th to look at this, that local to local. How do you do that well in a large scale, Fortune 1 company? And so there's a lot of interesting trends in that area. And venture capital obviously plays the roles in funding the innovations along the way.
Average, in other words, for every company that you invest in, what percentage will succeed and what percent will fail?
Yeah, what is my batting average? And I'll talk about this more broadly. I loved the idea of venture. When I first heard about it, they said it's the only thing you can actually do worse than baseball and get paid for it. So, so if you're like, 300 or something in baseball, I guess you're doing well. But that's what venture is, actually. In general, if you make 10 investments in venture, there'll be one of them that does pretty well, a couple more that do okay, maybe return of capital a little worse, and as you work your way down, 7 of the companies don't return their capital broadly across venture nowadays, and 3 or 4 of those 10 may lose 100% of their capital. Now, we've had a better batting average now. 85% of every dollar we've put out, we've gotten a return of capital on. And I don't think that's because we're smarter than the people on the West Coast. I think it's because of 2 things. One is we have a lot less people trying to get into venture deals here in Columbus. So when we pick something, we've had hundreds of things to pick from, and we pick one every quarter on average to invest in. So it allows us to make a little smarter decision because we have more data to look at. On the West Coast, they're getting to the point where they're actually fighting over the best deals, and really good deals get ignored. The next thing, looks like I'm getting the hook soon here. The next thing that I think is different is the Midwest ethic of not failing. So we define success in the Midwest as not failing, and I don't think this is necessarily a good thing for us overall. I think we've got to accept a little more failure. I think our batting average being as high as it is, we're probably not taking enough risk. We probably aren't being as innovative as we could be. We haven't had something. Our best return was 40 times the amount of capital we put in. The best return on a West Coast firm, it's not unusual for them to get 100 times their capital back. So our overall returns were best in the Midwest as NCT Ventures, but when we go up against our counterparts nationally, we're only in the top quartile. So getting into that top decile, I think, does take a little more risk. One more question.
Kind of the ratio of companies that you guys screen versus invest in, and how has that changed over the lifetime of NCT?
So ratio of screened versus invested companies, and how has it changed? I think the national average here again is about 1% of companies that get through a whole screening process get invested in. Ours is pretty close to that and has stayed pretty close to that. It's getting lower now. We're probably going to end up closer to 0.5% of the companies we screened we invested in, and the big difference there is that there's just so much more innovation happening than there was before, and you have a limited amount of capital. So thank you. I appreciate all the good questions and the time today.
Personal story is truly a budding entrepreneur in college is one who just was burning to be an entrepreneur, and you've been a serial entrepreneur ever since. Again, show of hands for all the bankers in the room. Did you hear him say he loves bankers? It must have been the undertaker that called him a vulture capitalist, not the bankers, since he loves us. I even put my Fifth Third pin on after you said you love bankers. Thank you for joining today. Be the inspiration.